Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. As real estate investors, we have to pay attention to a lot of things. And today we'll talk about inflation, interest rates, gold, and real estate with our ever-popular friend, Peter Schiff. He's got an opinion about all of it, and he'll share it with you today on the Real Estate Guys radio program. As I speak, inflation is robbing you at a rate north of 10%. Last year, the number one zip code that Mid-South homebuyers offered income property to Real Estate Guys listeners in appreciated by 21%. To harness that spread and protect and grow your wealth in the current economic storm, you need the 2 decades of experience in renovation and management that Mid-South homebuyers brings to their investors. Every home Mid-South offers you will have brand new components, a new 30-year roof, and a high-quality renter, all in a price range under $150,000. Their empathetic property managers will use your ROI as their North Star, while the lack of repairs on their totally renovated properties contributes to their almost 4-year average renter stay and 99% occupancy rate. Learn about their lifetime occupancy guarantee and total 1-year maintenance guarantee by emailing midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com. You'll be glad you did. Welcome to the Real Estate Guys radio show. I'm your host, Robert Helms, and with me, financial strategist Russell Gray.
Hey, Robert.
We love real estate, but the bigger picture is before you're a real estate investor, you're an investor, meaning you want to put your production to use, live below your means, have some savings, put capital into the marketplace. And for that reason, we have always paid attention not just to real estate, but to broader picture economics.
Well, if you think about your portfolio or any asset in your portfolio as a ship on a sea, there's a lot going on above you. There's a lot going on below you. And if you are not a skilled mariner, you can get caught by bad weather. You can end up pointed in the wrong direction. If you look back in history at the people who've had to navigate stormy seas, the skilled ones are the ones that survive. And I think that with today's dynamics, it's more important than ever to pay attention. Obviously, we've told the story 1,000 times on this show in the last 15 years, but 2008 taught us that if you don't pay attention to these bigger things, all that stuff that happens in the macroverse rolls downhill onto Main Street. Main Streeters get blindsided because they don't think that it applies to them. So because of that, for many years, we have been following and interviewing and talking with people who are much more skilled at understanding these tea leaves than we are. And so I encourage you, if you haven't begun that educational journey yourself, to do it, because it's easier to get out of the way of something you see coming far off than it is to try to move and navigate something that moves as slowly as real estate quickly when things start to break fast.
And as real estate investors, we're always paying attention to things like tenant-landlord law and appraisal practice and what's going on in our local markets and net in-migration and studying just what's available and competitive set. And then we have to know all about what it takes to do CapEx on property and so forth. But you do have to step back and look at the bigger picture. I remember years ago, our guest today was first seated in the chair across from us, and he had called the crash. In 2006, he wrote a book called Crash Proof, where he was explaining about the impending doom in the real estate market specifically, and he was laughed out of the room at the Mortgage Bankers Association, and lo and behold, the crisis happened. And it happened for exactly the reason he said he would, and he was right, and most people were wrong. And we asked him that very first time, how did you know? And his answer was, well, how didn't you see it coming? And we thought, wow, this is a guy that's not a real estate guy, but he's paying attention and he saw it coming. We better get around him. And we've done that and formed a great friendship over the last many years. Today, we'll talk about gold, inflation, interest rates, and real estate with Peter Schiff on the Real Estate Guys radio program.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
All aboard! Registration is open for the Real Estate Guys 22nd Annual Investor Summit. Imagine spending more than a week with like-minded investors, world-class educators, and real-world professionals. Returning in 2024 is the editor of the Gold newsletter, Brian London, real estate developer Beth Clifford, and the rebel capitalist George Gammon. Back with us in 2024, sales legend and best-selling author Tom Hopkins. And joining us live and in person for his 12th Investor Summit, Ken McElroy. Plus 2 brand new faculty members we can't even mention yet, and a lot more. It all begins June 13th in Fort Lauderdale, Florida. Visit investorsummitatc.com to get all the details and reserve your spot. This transformational week is like no conference you've ever attended. Go to investorsummitatc.com and make plans to spend a week with the real estate guys, Ken McElroy, Tom Hopkins, and an all-star faculty on the 22nd annual Investors Summit at Sea.
Too many people become victims of frivolous lawsuits and scammers simply because they were unprepared. At Corporate Direct, we use the latest legal tools to help our clients of all sizes create a strategy to protect what is theirs. Asset protection is not only for the wealthy. Our strategies and tools are very affordable and practical. Give us a call at 1-800-600-1760 or go to corporatedirect.com to see how we can help you. That's 1-800-600-1760 for corporatedirect.com.
Hi, I'm Mark Victor Hans. You're listening to The Real Estate Guys. If you want to expand your consciousness, expand your wealth, expand your future, and have more delight and excite in your future than in your past, keep listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program, now in our 28th year of broadcast. We love talking about real estate, but we think it's super important to talk broader picture economics. Nobody's more prepared to talk about that than our good friend Peter Schiff. Hey, Peter.
Hey, Robert, how are you?
I'm good. How are you doing?
I'm doing okay. We're getting ready to go on our spring break down to Mexico. We'll be there for 10 days.
Celebrating your birthday.
Yeah, I mean, it's going to be my birthday, March 23rd. But actually, what brought us down there was an event that Schiff Sovereign is having. It's our first conference. James Hickman and I kind of merged that part of my business. And so we're doing a conference for the Total Access members in Mexico City. And it happens to fall over spring break. So we're bringing the kids. And then we're going to this dude ranch to ride horses down in Mexico. I haven't been on a horse in quite a while. So we'll see how I do.
Right on. Well, that sounds like a ton of fun. Say hi to James for us. Been on his list forever. I think I was maybe one of his first 100 subscribers back in the day when he was writing as Simon Black. And now full circle here you guys are with Schiff Sovereign. So excited about that. Hey, Peter, we're trying to make some sense of, all the craziness in the market. And I wanted to talk to you specifically about this idea that everybody says, oh, inflation, that was yesterday's news. The genie's back in the bottle. No, look, inflation is low. But I don't think that's exactly right.
You're correct. That is not right. Inflation is as much of a problem as it's been. The problem hasn't gone away. Are the headline numbers not as high as they were a year ago? Yes, of course.
Right.
But that doesn't mean those numbers are not going back up or that they won't actually be higher than they were. The high water mark was 9.1%, and that was about a year ago. And now we're in the low threes. But I think we're likely to head back up again. All of the factors that drove the CPI to 9% are still present. In fact, they're even more present. Inflation is really a function of deficit spending and the demand that deficit spending creates and the tendency of central banks to fund those deficits by printing more money. And it's that expansion of the money supply that is driving prices higher. And not just money, but credit, the availability and the ease with which consumers can tap credit markets to fuel spending. Because you can buy stuff with credit as easily as with money. And so the two act the same. And it's the demand side that is driving prices up. It's the supply side that would work to keep prices down. If businesses are more productive and there's more stuff to buy, then that would push prices down. And if you actually look at the manufacturing numbers, we're in a recession there. So we're not producing more stuff. We're actually producing less stuff.
Right.
So that's an ingredient for much higher prices. So I think that the Fed, investors completely have got this story wrong if they believe that the rate hikes in and of themselves, just because the Fed took rates from 0 to 5.25, that's going to do it. That's not going to do it, because the higher rates have not had the intended effect. They haven't slowed borrowing and spending. That has continued. There has not been an adjustment in spending patterns or behavior as a result of the higher interest rates. And in fact, the higher interest rates themselves are making the situation worse, because federal budget deficits are now much higher, because the federal government has to pay a lot more interest on its debt. That is a inflationary development, because those larger deficits ultimately are going to be monetized, but they're fueling excess demand right now. Household debt, credit card debt continues to rise at all-time record highs. So the consumer is not saving more and spending less. So the rate hikes have been ineffective. And to think that 5% interest rates is some restrictive policy, if you look at the post, World War II era with a fiat monetary system, 5% is still lower than the average. I mean, you can't count the last 12 or 13 years of zero. I mean, that's an aberration. But if you go from before the 2008 financial crisis to, 1971, when we went off the gold standard, the rate that we have right now is historically low. So it's not a restrictive policy, and the fiscal policy is highly stimulative. We have the type of fiscal policy that, if you're a Keynesian, which I'm not, but if you were, we're running the type of fiscal policy that Keynes says you run when you don't have any inflation at all.
Yeah.
And when you have high inflation, like we have, you need to cut government spending. And we didn't. We didn't cut any government spending, or you raise taxes. And we didn't raise taxes either.
Peter, we showed a chart at an event we did a couple of weeks ago that had the interest rates on real estate, which is obviously different than the Fed rate, but there's a relationship, from 1977 to 2002. And there wasn't a single year when rates were below 6. And there were a lot of years where interest rates on homes were 12%, 16%, 11%. So you make a good point. I do think that, our audience, real estate investors, there's so many of them waiting for the rates to come back down, because they've only been investing maybe a decade, and they assume rates should be at 2 or 3 or 4% for real estate. Now that they're up at 6 and 7%, they're waiting. What do you say about interest rates on real estate and where that may be headed?
Well, I think real estate or mortgage rates are headed higher. I mean, there's no question that is going to be the case, especially if the Federal Reserve is no longer buying mortgage-backed securities. In fact, at the moment, they are selling mortgage-backed securities. So I think rates are headed quite a bit higher than they were. I think that the peak, we might have peaked out at around 8%. I think we might have got that high before we pulled back down. But I think Treasury yields are headed higher, and then mortgage rates are going to follow.
So the other part of the real estate equation is that it has to do with the rates. It's the fact that, commercial mortgages tend to be shorter, 5 years, 10 years. And unlike home loans, where you can pretty easily refinance or you can get a 30-year mortgage, that's not really the case in commercial. And we've been talking about on this show how there's this big pile of debt that's going to have to be refied. And at higher rates, that's going to ripple perhaps through the entire economy.
Yeah, well, the government, when interest rates were really low, they didn't take advantage of that by locking in those rates like the homeowners did, right? They saw the opportunity to take a 30-year fixed rate mortgage because they knew that, hey, these are great rates. I want to lock them in. Well, the U.S. government didn't do the same thing. When 30-year treasuries were 1%, 1.5%, the U.S. government didn't say, hey, let me lock these rates in. They borrowed in the 90-day bill market because they were paying 25 basis points. And they're still doing that. In fact, they're not taking advantage of the fact that a 10-year treasury is 4.3 because at the end of the day, that's still a low rate. The government is now borrowing at 5.25%. In 1980, when rates went to 20%, short-term rates actually peaked at 21%. That didn't impact the vast majority of the then national debt. It only impacted the new borrowing, the current budget deficits, because most of the debt was locked in at the lower rates. But to the extent that we have a big increase in short-term rates now, it's going to impact, a large percentage of the national debt.
Well, and I think, one of the issues with real estate investors is certainly the interest rate and the mortgage are important because we use leverage to buy property. But there's a lot of properties that still make sense at these average type of rates. But the other side of the equation you hit on with inflation is just expenses are higher. Insurance has gone up and all of the expenses that are a result of inflation. And I know you talk a lot about the difference between disinflation and deflation. But even though we've seen inflation go down from an annualized 9% to an annualized 3+, it's still all prices are going up.
Yeah. And in fact, the only price that's not going up if you're a homeowner is your mortgage, if you have a fixed rate mortgage. But your maintenance, your insurance, your taxes, all of these costs, utilities, have been rising sharply for homeowners. But to the extent that they at least locked in their mortgage, they have some protection. And that's one of the reasons that you're not seeing a big drop in home prices that you would normally have when you have a rise in interest rates, because so many people are staying in their homes because of the mortgage. It's the mortgage that is really valuable, more so than the property. But the only way to keep the mortgage is not to sell the property. And so people aren't selling properties. That means that there's not a lot of supply out there. And also there's not a lot of construction because the construction costs are very high.
Hey, let's take a quick aside on the real estate market, because several years ago, you and your family moved to Puerto Rico, and a lot of folks were moving there, and we've shared on the show kind of the tax benefits of that for U.S. citizens. But because of that, how is the real estate market in Puerto Rico?
Well, it's hard to say exactly, but there was a huge rise in real estate prices that really began in 2020. Because, I came here in 2013 and bought some property, and I bought another house in 2017. And up until 2020, the appreciation, was a normal probably. I think I could have sold the properties and maybe made, a 20% gain or something like that. Certainly the one I bought in 2013, I think I could have gotten more money for. But then when COVID hit, everything just went ballistic, where people were paying 5, 6, 7 times what I paid for similar properties. So it really was, an explosion of demand with a lack of supply.
Right.
People really wanted to live in this community, and the people that lived here didn't want to move.
Right.
And so what happened was prices went up to the point where some people couldn't resist and sold. So if you bought a house for $2 million and somebody offered you $10 million for it a couple of years later, some people were like, you know what, I'm going to sell. And some people sold and just left Puerto Rico because it was a tax-free gain. And they figured, I came here to save money on taxes. I made all this money on my house. I'm just going to take that and I'm going to go home. And some people, moved to less desirable parts of Puerto Rico and put the difference in their pocket. But a lot of people were like, you know what, I'm here. I don't want to leave this community. And so that's what made the prices so high. But over time now, those high prices resulted in more properties on the market. And then, of course, there were some people who were reluctant to sell. Hey, maybe the market will keep going up. Maybe I'll get 20 million for my house, And so now more supply is on the market, and you don't have that rush of buying. We don't have nearly as many people coming as we had 2021. So the prices have come back down, not to where they were. So maybe the house that went from 2 million to 10 million is now 6 million. So it's still, triple. But, it's hard to say, where the market's going to settle. But there's a lot more houses for sale. So, and a lot of them aren't getting bought. So it still might be a question of the sellers want too much for their homes. But a lot of people, if they can't get the high prices, they don't want to move. Because when you're buying in Dorado, you're getting your tax savings. So if you're saving $2 million, $3 million, $5 million a year on your taxes by living in Puerto Rico, that makes the high house price worth it. Especially if the wife, maybe the husband, wants to move here, and the wife is like, okay, well, we can do it, but we have to live in this community. Otherwise, we're not doing it, because it's like it's the best community for families. And so if you have to overpay for your house in order to get the wife to agree to the move, it's still worth it. And, the guys like the community too. And it's a phenomenal community to live in. I mean, I compare it to like, being in college, except with better liquor and, better parties. But it's like being on a campus. I mean, I know so many people here, and there's parties all the time. There's events all the time. I mean, for kids, for adults. I don't think there's any other community in the world that's anything like it. And, and it's all, none of the people are from, there's a few people they grew up in Puerto Rico, but the vast majority of the people that live here moved here from other parts of the United States. They're successful people, they're motivated, because in order to move here, I mean, it takes a certain degree of adventurism and success. I mean, there's a big cost to coming here, and obviously there's a big cost to buying property here. So you have to be pretty successful. You have to be making a decent amount of money. So it's, it's very unique in the type of people. People would say, oh, it's kind of like, Galt's Gulch, from Atlas Shrugged. And so maybe it's the closest thing to that.
Who is John Galt? So, hey, I just wanted to bring it up because it's a great real estate story that when you have a demand that gets stimulated by Act 20 and 22, then what happens is prices go up because there's more demand and supply. So that was a great illustration of that. And maybe a segue. I saw a picture of you and former presidential candidate Vivek the other day on the beach. That's kind of fun.
I just ran into him. There was a party of Beatles. We had a Beatles cover band on the beach. They were great. And I had to leave because we had a dinner that we were going to. On my way out, someone said, have you met Vivek? And he just happened to be there on the beach with his family visiting a neighbor. So I went down and said hello to him. And interesting, one of his bodyguards was a big fan of mine, who was like, oh, Peter Schiff. So but yeah, like we got the Pauls living here. There's, my next door neighbor is Ricky Barton. So we got people, and there are other people here that, people might know. But it's a great community, but it wasn't just the acts. What really sparked it was this work from home, because we then even had corporate executives were moving here because companies said, you can be the CEO of this company, but you don't have to come to work. You can work from home. And once they were told they could work from home, it's like, screw it, I'm going to work from Puerto Rico, right? What's the difference, right? So it sparked another wave of people seeing the possibilities of, being in Puerto Rico. And then, of course, when Biden was first elected, there was the fear, too, of big increase in taxes. They were talking about it. And we never really got that. But there is talk of a wealth tax or much higher income taxes. And so that generated more interest, because the higher the taxes are in the U.S., the more you save by moving to Puerto Rico. So it increases the attractiveness of making that move.
Our guest today is investor and author Peter Schiff. We'll have more with Peter when we come back, and we'll give you a chance to win one of his great books on real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Hey, it's Robert Helms. Thanks so much for listening to the show today. I want to personally invite you to come see an amazing real estate market that combines excellent cash flow, offshore diversification, and what we affectionately call lifestyle investing. Come join me from July 19th to the 22nd in the beautiful country of Belize. The Real Estate Guys have been bringing investors to Belize for more than 18 years now, and our discovery trip is designed to show you the market like nobody else can. Sure, Belize is breathtakingly beautiful, the people are wonderful, and wait till you taste the food. But the real opportunity is the real estate investment potential. There's all kinds of opportunity in Belize when it comes to real estate, including both long and short-term rentals, commercial and retail triple net properties, business opportunities, land acquisition, development, agriculture, and more. And as the only country in Latin America with English as its official language, it's easy to understand the law. Property rights are strong, and contracts are in English. And in the top tourist market, a unique situation exists where demand for rentals continues to outstrip supply, creating a compelling environment for investors. So come see for yourself. Join me July 19th to 22nd in Ambergris Caye, Belize, as we study the market, learn about the sustainable drivers, and tour lots of beautiful real estate. And like all of our field trips, there are no properties for sale during the weekend. Rather, you'll meet lots of local providers that will help educate you about the market so that you can follow up with them after the trip if the market is interesting to you. You've heard about Belize on the Real Estate Guys for all these years? Now come see what all the excitement is about. Plus, we'll have lots of time over meals and activities to talk about all things real estate. To get the details, go to the website at realestateguysradio.com and click on Events, where you'll find the Belize Discovery Trip. Once you register, you'll get information about our group hotel rates as well as travel details. So join me in Belize, July 19th to 22nd. It's a beautiful country with lots of amazing possibilities, and the only thing missing is you. Go to realestateguysradio.com under Events, and I look forward to seeing you in beautiful Belize.
Hey, it's Ken McElroy. I listen to the Real Estate Guys, and so should you.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, come and join me in beautiful Ambergris Caye, Belize, as we study the real estate market, hang out together, and have lots of fun. We've been offering this discovery trip for nearly 2 decades. It's about time you showed up. Get all the details on the website at realestateguysradio.com under Events, where you'll see the Belize Discovery Trip. We're talking with Peter Schiff today about a variety of things, and we've got more coming up. But first, let's play Real Estate Trivia. That's your chance to win a prize by knowing today's Real Estate Trivia question. It's going to have something with the topic we've covered, and the prize is going to be a good one. As soon as you hear the question and think you know the answer, send your best guess to trivia at realestateguysradio.com. Trivia at realestateguysradio.com. Give us your name, the answer to the question, and your physical mailing address. The first person that gets it right gets an awesome book called How an Economy Grows and Why It Crashes by Peter and Andrew Schiff. Peter, of course, Andrew's brother. This is a book that was a take on a book their dad wrote years and years ago. You're going to dig it. Last week on the Real Estate Guys, we had property manager Jay Hartley with us, and we asked this: name the worst U.S. airport for connecting flights. Well, the winner, if you want to call it that, is Denver International, followed by Chicago O'Hare and Salt Lake City. Finance Buzz based the ratings on the number of gates on opposite ends of terminals, the distances to the farthest gates in an airport, and the need for passengers to take trams or other transportation to reach their gates. By the way, the longest walk between 2 gates in Denver takes the average person more than a half hour. As if flying wasn't stressful enough already. Here's our real estate trivia question for this week. Puerto Rico is officially called the Commonwealth of Puerto Rico, an unincorporated territory of the U.S. Here's our trivia question. Who officially discovered the island in 1493? Yeah, it existed before that, of course. There were even some people there. But the official discovery came back in 1493. Who discovered Puerto Rico? If you know or want to guess, send your best guess to trivia at realestateguysradio.com. Give us your name, the answer to the question, and your physical mailing address. First person that gets it right gets How an Economy Grows and Why It Crashes by Peter and Andrew Schiff. That's today's real estate trivia question. Now, Peter, we're not very political here on the Real Estate Guys. We love everybody. But as a real estate investor, this is an election year. And during the election cycle, it's just more difficult than ever to navigate. Depending on what the White House occupants look like in the next year, we're going to have big differences in terms of policy, in terms of taxation. I know you don't have a crystal ball, but how can an investor prepare today knowing there might be two very different outcomes?
Well, I don't know that from an investment perspective, it really makes a difference whether it's Biden or Trump or somebody else. And the only way I think it would be someone else, I don't think it's the third party. I don't think like a Kennedy or some libertarian candidate is going to win just because Biden and Trump are polarizing and unpopular with certain groups, but popular with others. It would be if maybe Biden is not on the ticket, maybe Biden steps down, and so somebody else is there. But I think that inflation is going to be a problem regardless of the outcome of this election. The budget deficits are going to get larger, and so I think that the investment themes are going to be the same. Now, on the margin, do I think things could be worse under a second Biden term than a second Trump term? Sure. Could the budget deficits be even bigger? Yeah, I guess. And with Trump, we could have less government regulation. There could be other positive factors to offset some of these negatives, but I don't think it's a game changer. Look, I don't think Trump's first term was a game changer. The deficits went up. Not only did the budget deficits go up under Trump, but the trade deficits went up. The government got bigger, even before COVID. But then the Trump COVID response was a big government Keynesian response. It was let's print money, and let's send out stimulus checks. So the way he handled that was indicative that, that's the way he would handle a problem in the future. No, I don't think it really is going to make a difference. I think there are other cultural things. I mean, I think it's better for the country to get off this track, socially, with the political correctness and a lot of the hard left that's driving Biden. So I think at least we could get, diminish that if we get rid of him. I'd like to see Trump win because, it's the enemy of your enemy is your friend. And the people who really don't like Trump are the people I'd like to see disappointed in the outcome of this election. I mean, and the powers that be, they're doing everything they can to try to stop him, fabricating phony charges, criminal, civil charges, criminal charges. I mean, I think what really epitomizes it too, and the media is so arrogant for, just getting away with it, was the way they took out of context his speech the other day about the auto industry and the bloodbath in the auto industry that he thought would happen if China flooded the market with cheap imports. He was talking about auto jobs being lost. And so it's a symbolic bloodbath. He wasn't talking about actual violence and people being stabbed and bleeding. It was bloodbath is a common word to describe the situation that he was envisioning if his policies, were not in place. Now, you could disagree. I mean, I don't think tariffs are the answer, but the media took that comment, bloodbath, and went as if Trump was saying that if he loses the election, there's going to be riots and there's going to be blood, that it's going to be another, January 6th, where his supporters are going to take to the streets and go on a murderous rampage. And they knew that that's not what he said, yet they accused him of it anyway. And they still refused to admit that they did that. They're still trying to claim, well, he really was talking about a real bloodbath. And of course he wasn't. But, the conventional media, mainstream media, lies. They don't report the news. They fabricate fake news. That's the reality. I mean, I experienced it personally with what happened with me and my bank, where the media just makes up a story.
Right.
And then even when they're wrong, even when I sue and win a defamation lawsuit, they bury that. They refuse to admit that I won the lawsuit and that what the media said was not true. And that's why, you have to take all this, with less than a grain of salt. And if you want to know what's happening, you can't look to the mainstream media because they're regurgitating propaganda. They don't want you to know the truth. They just want you to know what they want you to believe. And they'll distort the facts and misrepresent them to get you to believe a lie. But if you look out for alternative sources of media, maybe you listen to the Real Estate Guys or you listen to the Peter Schiff Show, you have a much better chance of getting news. I mean, it's not, we don't have, Walter Cronkites or Dan Rathers, even though these guys certainly had their politics, they kept it out of their news. They reported what actually happened.
So true. And I'm actually encouraged by the fact that alternative media has really taken off, right? We've been on traditional radio more than a quarter of a century. But the podcast version of the show is the one that has the most listenership. You just passed 1 million followers on Twitter, right? There's more people who follow you on Twitter than there are who watch some of the major media newscasts today.
Yeah, and there's a lot of actual interaction. There's a lot of engagement on my Twitter feed. So people are paying attention to what I write there. So yeah, I mean, I have the ability to disseminate some information. So the media tells a lie and I could post the truth, and then people could get that information. It took me a long time, 15 years or so, to get up to a million followers. That last 10,000 was like, pulling teeth. It took a long time because I keep losing followers. That's the problem. You gain them, you lose them, you gain them, you lose them. Every night, I see the followers go away. And I don't know if that's people actually unfollowing me. I mean, some people probably unfollow me, or is it the platform scrubbing accounts that it turns out are inactive or fake or whatever's going on?
Yeah, hard to say, but you're trending in the right direction. Hey, Peter, let's talk about one of our favorite topics, you and I, and we're real estate guys, but we love the metals, and gold has really been on a tear lately. You've been telling of this, saying, guys, this is going to happen. Where do you think we are with the metals market, and what do you think happens next?
Well, I mean, gold hit a new all-time record high. We almost got to 2,200 on the gold price, and we've pulled back a bit. We're maybe 2,150-ish. But the trend is clearly up for gold, which really just shows you the trend is down for fiat currencies.
Right.
That's really what gold's telling you. I mean, 100 years ago, you could buy an ounce of gold for $20, and now it takes more than $2,000. So that's a 99% plus depreciation of the dollar over that 100 years. But in the 100 years before that, the price of gold was stable at $20. You could buy an ounce of gold for $20 in 1800, and you could buy an ounce of gold for $20 in 1900. So when we were on a gold standard, you had stable purchasing power for the dollar. When we went off the gold standard and had a Fed, the dollar lost its purchasing power. I think the rate at which the dollar loses value is going to be accelerating now. So it's going to lose a lot more value over the next 100 years. In fact, it could lose more value over the next 10 years than it lost in the previous 100. We'll see. But I think that, it's going to accelerate as the deficits are exploding out of control. So gold prices are going to go much higher to reflect that. And when is it really going to start to take off? It's hard to say. I think that what's holding gold back now is that false perception that we mentioned at the beginning of this conversation, that inflation is dead and buried, that the Fed, it won the inflation battle, and that we don't have to worry about inflation. It's going to go back down to 2% and stay there forever. And when the markets come to terms with the reality that just ain't so, that inflation is not going back down to 2%, it's more likely to be 20% than 2%, and that the days of low inflation, if they ever were really here, are gone. And now you have to incorporate a much higher inflation rate into the gold price. Gold's going to take off.
Now, the stock market also at all-time highs. There's folks saying, hey, the run is just getting started and we're going to the moon. And other folks are saying it shouldn't be where it is. Part of that is the printing of money, if you will, and inflation. But what else is happening in the stock market that people should pay attention to? This is an area that obviously you're very well versed in.
Yeah, well, I think right now, the stock market at least is dominated by a handful of stocks that are really driving all of the gains. They're generally tied into the AI theme. And, this is, a very narrow group of stocks and very reminiscent of, the four horsemen of the dot-com bubble, or, the nifty 50 stocks of the 1960s, the Polaroids and the Xeroxes. And, it's not a healthy market when you don't have the breadth. And I think it's all based on the false belief that inflation is gone and the Fed's going to dramatically reduce interest rates. And that's going to prop up the market, the increased liquidity and lower rates. I think people need to be very leery of the overall stock market. But, you'd still have to get out of dollars. You still can't just be holding cash. So I think there are stocks that people should own. And they're not the stocks that everybody is buying right now. But I think the best opportunities in stocks are outside the U.S. I think the emerging markets are probably have the most upside. But also, in the developed markets, good value stocks that pay good dividends. People need to own real things, real assets in an inflationary environment, and inflation is going to be in the environment for a long time, and it's going to get a lot worse. So people need to invest, and those are the strategies we have. I think the stocks that we're investing in for our clients and our mutual funds and our managed accounts, I think they'll do very well. I think they'll do well, like stocks did well in the 1970s if you bought the right stocks. If you were still holding the nifty 50 stocks, you got slaughtered in the 1970s. But if you got out of those stocks and you bought oil stocks, you bought gold stocks, you bought Japanese stocks, you made a lot of money during the 1970s. So I think the same thing will be true this decade, or it may even be longer time period.
If you'd like to learn more about what Peter's team does in that regard, you can go to Euro-Pacific Asset Management at Euro-Pac.com. And obviously, you should be listening to the Peter Schiff Show. Once or twice a week, it seems that you're bringing us a solid hour of reflections on the market and great observations.
Yeah, and depending on if I have the time and there's enough going on, sometimes I do it 3 times. But yeah, normally it's once or twice, depending on what happens in the market and the economy and how much free time I have to do it. A lot of times life gets in the way of the podcast. I end up, either I have work to do or I have something social going on, and I just, don't have the time to do it.
Well, we've got something for you that's both social and work to do. You're going to be joining us for the 22nd Annual Investors Summit at Sea. We are thrilled to be getting back on a cruise ship.
Is it really 22 of them?
22nd. This, I think, is your 11th or 12th, something like that.
Yeah, we are looking forward to it. I haven't been on a cruise ship since pre-COVID. We missed going on those adventures. And this time it's over the summer. So it's, or I forget, when were they happening before? Were they?
Yeah, so we've done it in January. We've done it in April. One year we did it over your birthday. And the last few years, it's been in June. So this year, June 13th to the 23rd, couple of days in a hotel. And then we get on a beautiful brand new cruise ship.
It's good because we can take the kids because they don't have school.
Yep.
But they start camp on the 23rd. So we have to really book it out of that ship so that we can drop them off in camp that afternoon. At least it coordinated with the beginning of that. But yeah, I would certainly invite the listeners to your program if they haven't yet participated in one of these Summit at Seas, that they take advantage. I don't know if you still have any availability left, but if there's some space, I would encourage people to join us. You'll have a lot of fun. You guys are great hosts. In fact, I can't even imagine going on a cruise that wasn't a Summit at Sea. It would probably be a letdown if I was just on a regular cruise without you guys to provide the extra entertainment. And it's a great group of people too. Just like I said, it's a great community here in Dorado where I live. It's a great group of people to cruise with, to have dinners with, to go on the excursions with. It's really like a cruise within a cruise. Because a cruise ship has got thousands of people. But, we condense this group down to maybe 100 to 200 people with the faculty and the attendees. But it makes it a little, a better experience, I think, a little bit more intimate, that you're not just immersed in this, because you can kind of tune out the rest of the cruise. And you have a smaller group.
Very much so. All the benefits of the big, beautiful cruise ship, but we're our own little microcosm in there. Well, super stuff. Hey, my friend, it's been great catching up. Always appreciate your insight. Have a fabulous birthday, and we will see you on the Investor Summit.
I will. I'll see you then.
There's Peter Schiff. You can check out the Peter Schiff Show where all your favorite podcasts reside. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Real Estate Guys listeners, are you tired of losing real estate deals due to financing issues? Have you had enough of waiting on banks, lenders, and investor groups to fund new projects? What if there were a way to eliminate all the hassle and invest in real estate on your own terms? I'm here to tell you there is. Patrick Donahoe here from Paradigm Life. I'm an Investopedia Top 100 Most Influential Financial Advisor, and I recently wrote a best-selling book about the financial strategy that changed my entire investment model, and the one that could change yours. To get a copy of my book for free and learn how you can maximize your real estate portfolio by acting as your own bank, send an email to mybank@realestateguysradio.com. Don't make another real estate deal without reading my book first. Email mybank@realestateguysradio.com now to get your copy for free.
Self-storage is an asset class that has stood the test of time. Going into the Great Recession of 2008, self-storage had the least negative impact of any of its commercial real estate peers, and it had explosive growth coming out of that time during the recovery. Fast forward to 2020, and you'll see that same pattern during some of the worst part of the pandemic. Hi, my name is Dave Zook, founder and CEO of The Real Asset Investor. Our operating partners are some of the best in the business, and we've had great success over the last decade buying mom-and-pop operated self-storage facilities and taking them to the next level by forcing value through increasing the square footage, adding climate-controlled units, bringing in our professional management teams, and turning the project into an institutional target. We have self-storage investment opportunities available for accredited investors who are interested in investing in this space for cash flow, tax impact, and huge equity appreciation. Reach out to us today at self-storage@realestateguysradio.com.
Hi, this is Mark Skousen, and you're listening to The Real Estate Guys.
And welcome back to the Real Estate Guys radio program. Thanks so much for tuning into the show. Hey, join us on the 22nd Annual Investor Summit along with Peter Schiff and a whole bunch of other great folks. Going to have an awesome time on the high seas. You get all the details by sending an email to summit@realestateguysradio.com, summit@realestateguysradio.com, or go to investorsummitatsea.com. Well, my goodness, what an awesome conversation with Peter Schiff.
You know, Peter made an interesting comment I took a note of, and he compared what's going on today with the 70s. And a couple of summits ago, I did a presentation on that exact topic. In fact, I dressed up as Barry Gibb.
Yes, you did.
And did this whole kind of funky presentation, try to make it entertaining while you're talking about macroeconomics. But this term stagflation has been floating around a long time, and that is when you have a slowdown in economic activity, a recession. At the same time, you have rising prices. And what you heard Peter talking about is a dynamic between supply and demand. And within the supply and demand, you've got the demand being the supply and demand of the currency. And then when there's an excess supply of currency and or credit, then that creates excess demand for goods and services against a backdrop of a decrease or a slowdown in goods and services. And so you end up with rising prices and a slowdown in production. And I think stagflation is something that a lot of investors today aren't old enough to really remember. Sadly, I am old enough to remember it. I lived through the 70s, and I remember looking at it, and it never happened again, but you started hearing the last few years that talk again. So I think that one advantage of listening to older guys like Peter, like us, is that we've seen some of those things, and history does repeat itself a little bit. So we're seeing some of that, and I think if you go back and look at the 70s and study some of the things that happened in the 70s and begin to think about how they might repeat themselves, you can begin to position your portfolio and the investment decisions you're making to be most insulated from the risks and to capitalize on what looks like will be the opportunities.
Well, and that's just a thing, right? Real estate investors respond to what happens in specific markets, but then they also have to deal with the broader market. And of course, we talked about interest rates and just people's opinion about that. And Peter comes from the camp, especially like a lot of us old guys, that, 6%, that ain't so bad. And that chart that I mentioned, you've got all those years where interest rates were 8 and 9 and 10. When I bought my first house, the interest rate was, I think, 9 3/4. So it's just a very different reality. But this is why we want to pay attention to not just real estate voices, but some macro voices as well.
Well, real estate is driven by credit and the credit markets, and healthy credit markets. I know, because in 2008, the credit markets collapsed and it took real estate prices with them, and it took a lot of the mortgage industry, which I was in at the time, with it. And so these macro factors really do matter. But the principle is very simple. It's basically when interest rates go up, bond values collapse. And in a system where the credit markets all operate on counterparty risk and collateral, people are making markets by pledging bonds. So if you've pledged a bond, in other words, borrowed against it in order to drive a credit transaction, and that bond loses value, you have a margin call, and then you get a liquidity crisis. And so we've seen some of that. That's what took down Silicon Valley Bank. We talked about that a year ago when it happened. And I think that one of the challenges the Fed has right now is that they can't really lower interest rates, although they're talking about lowering them slowly, because it fuels more inflation, which has been a big problem for them. So they're hoping that the economy will pick back up, I believe, in order to mute some of that inflation. At the same time, they raised rates so high, they can't raise rates to try to curb inflation, because if they do that, then they continue to destroy the bond market and the credit markets and actually slow down the growth of the economy. So they're walking a tightrope, unlike any Fed has ever had to deal with, because of the size of the debt, where the rates started, where they are today. So you might say, well, 5 or 6% is a reasonable interest rate, historically speaking, and you'd be 100% right. But compared to starting from 25 basis points, which is 1/4%, and then going up to 5 1/4, that's like a 20x increase. And when you talk about like back in the 80s with Paul Volcker, he took interest rates from 8 or 9 up to 18. We say, well, yeah, 18, that's brutal. Yeah, but it was only a little more than double where he started. It wasn't 20 times where he started. And the Fed took it up 20 times from where it started. So there's never been an interest rate cycle that's been as aggressive as this one. And it has inflicted a lot of pain. The question is, nobody knows exactly what's going to break, when it's going to break, where it's going to break. And Peter takes a lot of crap because he sees what's happening, and he predicts that things are going to happen. And I would agree with his premise. I think he's right. Where everybody gets caught up is they don't know when it's going to happen. It's the timing. So the trend is clear, but trends can last a long time before they become an event. You can sail down that river for a long time enjoying the sunshine, and all of a sudden you turn the corner, you're going over the waterfall. Right? It's hard to time that. So you got to be prepared for it to fall apart, but you got to be patient, because it might be a year, it might be 5 years, might be 10 years. So if you're sitting on capital like, hey, I'm going to step in when the market corrects, you may miss out on some opportunities. So to me, it just comes down to, especially with real estate, if you just underwrite a deal that makes sense in a decent market with good management and put a capital stack on it that gives you the ability to hold on to it for 10 years, no matter what happens, you're probably going to be okay.
Now, studying broader picture economics can be a little wonky, and if your ears are glossing over, well, we've got a couple of resources for you. A couple of years back, we recorded a pretty awesome 2-day event in more than a dozen modules called The Future of Money and Wealth. If you're interested in that, all you have to do is send an email to future@realestateguysradio.com. But really, a part of your every month activity has to be talking about these things, learning about these things, and our shortcut has been hanging around with smart folks. If that's something that you think would be interested, well, we would love to invite you to our mastermind, the Collective Inner Circle. It's Russ and I, plus George Gammon, Jason Hartman, and Kenny McElroy. We meet live 4 times a year. We meet a whole bunch of times virtually throughout the year. And to learn more about being part of the Collective Inner Circle Mastermind, just send an email to collective@realestateguysradio.com. Well, it's a lot to think about, but the markets are changing. The world is changing. We're happy to have Peter Schiff at the moment's notice to share with us. If you're interested in what Peter does, you can check out The Peter Schiff Show. That's Peter's podcast 2 or 3 times a week in all your favorite podcast outlets. Until next week, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and rich dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys radio show.